So let's now cross to Abuja to hear from Godwin Emefiele, the Central Bank Governor, to get his perspective on the outcome of the MPC's meeting.
Good afternoon, ladies and gentlemen. The Monetary Policy Committee, MPC, held its 262nd meeting on Monday the 23rd and Tuesday the 24th July 2018 amidst fragile improvements in global growth and fragile domestic economic recovery. The committee reviewed developments in the global and domestic economic and financial environments, as well as the outlook for the rest of the year. The MPC also assessed the risks to price stability, credit growth, employment creation, and financial system stability in the short to medium term. 10 members of the Monetary Policy Committee were in attendance. Global economic developments. Global growth momentum remained promising despite rising trade tensions, Brexit concerns, and improving developments in the Korean Peninsula. Global growth was projected at 3.9% in 2018, compared with 3.7% in 2017, largely driven by the recovery in oil prices, accommodative monetary policy, and increased consumer spending in some advanced economies. In the advanced economies, growth was projected at 2.4% in 2018, the same as in 2017. The projection was expected to be driven majorly by fiscal stimulus in the United States, coupled with accommodated financial conditions in advanced economies. In the emerging market economies and developing economies, output growth was projected at 4.9% in 2018, up from 4.7% in 2017, due largely to sustained recovery in global commodity prices, particularly crude oil, rebound in investments, manufacturing and trade, as well as the strengthening of domestic consumption. The downside risk to global output growth remains the build-up in financial vulnerabilities, rising cost of borrowing in emerging markets and developing economies, fragile corporate balance sheets, escalating trade protectionism, uncertainties around the Brexit negotiations, heightened geopolitical tensions, and fiscal sustainability concerns. Global inflation was predicted at 3.2% in 2018, driven by rising energy prices and currency depreciations in some emerging markets and developing economies. In the advanced economies, inflation was projected to increase to 2.2% in 2018, up from 1.7% in 2017, as a result of increases in the cost of transport, housing, energy, and food. Similarly, inflation in the emerging markets and developing economies is projected to rise from 4% in 2017 to 4.4% in 2018 due to currency depreciations and rise in energy prices. The committee believes that global inflation is likely to remain subdued over the medium term relative to long-term trends, despite subsisting monetary accommodation in some advanced economies. Domestic output developments. Economic recovery was sustained with a positive outlook over the medium term, anchored on oil price recovery, fiscal spending, and stability in the foreign exchange market. Data from the Nigerian National Bureau of Statistics, NBS, showed that real gross domestic product (GDP) grew by 1.95% in the first quarter of 2018, compared with 2.11% and a contraction of 0.91% in the preceding and corresponding quarters of 2017, respectively. The oil sector, which contributed 1.26% in 2018, compared with 0.76% during the fourth quarter of 2017, was the major source of the growth. The Purchasing Managers Index for manufacturing and non-manufacturing activities rose for the 15th and the 14th consecutive months to 57 and 57.5 index points respectively in June 2018. The committee noted the positive impact of the sustained improvements in foreign exchange supply on the performance of manufacturing and other key sectors of the economy. The committee welcomed the positive economic growth, but observed that the recovery was still fragile and called for the speedy implementation of the 2018 federal government budget and the economic recovery and growth plan to strengthen output growth in the Nigerian economy. Developments in the money market. The committee observed that narrow money M1 contracted by 4.25%, annualized to minus 8.49% compared with the provisional benchmark of 8.04%. Broad money supply M2, however, grew by 2.79% in June 2018, annualized to 5.58% compared with the provisional growth benchmark of 10.84% for 2018. The increase in M2 was mainly driven by the net foreign assets, which grew by 18.15% in June 2018, annualized to 36.3% compared with the provisional benchmark of 18.15% for 2018. The development reflected the improvement in foreign receipts arising from favorable crude oil prices. On the other hand, net domestic credit contracted by 1.4% annualized to minus 2.8% compared with the provisional benchmark of 12.45%. The development was driven largely by increase in net credit to government, which contracted by 9.74% in June 2018, annualized to minus 19.48% against the provisional benchmark of 54.97%. Credit to the private sector similarly contracted by 0.04%, annualized to minus 0.08% in June 2018, in contrast to the provisional annual benchmark of 5.64%. A revised and seasonally adjusted money supply aggregate, however, showed an uptick. The new aggregate M3, which is still being finalized by the bank, appears to comprehensively capture the liquidity in and outside the banking system compared with the existing M2. More details about the impact of M3 on macroeconomic variables will be reviewed at future MPC meetings. Headline inflation year-on-year trended downwards for the 17th consecutive month to 11.23% in June 2018 from 11.61% in May 2018. Food and core inflation also fell to 12.98% and 10.40% from 13.45% and 10.71% respectively over the same period. Committee, however, noted the rise in the inflation rate to 1.24% in June from 1.09% in May 2018. Food inflation month on month also increased from 1.33% in May to 1.57% in June 2018, representing an increase of 0.24 percentage points. During the same period, core inflation month on month also rose by 0.05 percentage points, 0.98% in May 2018 to 1.03% in June 2018. In view of the trend in rising month-on-month inflation rate, amid the slowly declining year-on-year headline inflation, indications are that inflationary pressures are rebuilding in the domestic economy, and dealing with this requires further impetus in the future. The review of developments in the money market revealed that the average interbank call rate fell to 5% in June 2018 from 25.43% in May 2018, while the average open buyback OBB rate decreased from 18.37% in May to 10.84% in June 2018. The trend in market rates and the net liquidity position reflected the impact of the auction of open market operations bills, foreign exchange interventions, FAC allocations to various levels of government, as well as the servicing of maturing CBN bills. External reserves stood at $47.2 billion on June 23, 2018. The committee was optimistic and expected further increases in the level of external reserves in the near term, citing the favorable crude oil prices. The committee therefore advised the bank to sustain its current efforts to maintain investor confidence and ensure accretion to external reserves. The MPC also called on the federal government to continue to build fiscal buffers against possible oil shocks in the future, noting that the rise in the monthly distribution of revenues at the FAC portend the danger of having reserves buffers to absorb shocks in the future. The oil share index increased marginally by 0.09% to 38,278.55 on June 29, 2018, from 38,243.19 at end of December 2017. Market capitalization increased by 1.89% to 13.87 trillion naira on June 29, 2018, from 13.61 trillion as at December 2017 year end. However, oil share index and market capitalization fell by 7.24% respectively, and on June 29, 2018 compared with the level at end of April 2018, due majorly to profit-taking activities of investors and the effect of monetary policy normalization in some advanced economies, especially the United States. The committee noted with satisfaction the relative stability in the foreign exchange market and high level of activities, particularly at the investors and exporters window. Committee noted the commencement of the currency swap deal with the People's Bank of China and noted that the availability of renminbi currency to Nigeria investors would ease pressure in the foreign exchange market. The MPC called for speedy implementation of the framework of the currency swap and urged the bank to carry out sensitization of the Nigerian public. The overall outlook and risks to the domestic economy. The forecast of key macroeconomic indicators point to a positive economic growth in the second half of 2018. The expectation is premised on the implementation of the 2018 budget, sustained stability in the foreign exchange market, as well as increase in crude oil production and prices. The MPC cautioned that the downside risk to the growth outlook to include continuing delay in the implementation of the 2018 budget, worsening farmers and herdsmen conflict in some parts of the country, continued non-payment of workers' salaries and pensions in some states, rising sovereign debt, as well as uncertainties surrounding the direction of trade policy, including the external demand for Nigeria's oil. Inflation forecast for the near term points to further moderation in price level. However, the downside risks to inflation include the impact of excess liquidity that could arise from the implementation of the approved 9.1 trillion naira 2018 federal government budget, pre-election spending, anticipated review of salaries and wages, security challenges, and monthly FAC injections. These could boost aggregate demand, but would equally exert an upward pressure on domestic prices for the rest of the year. The committee therefore called for a coordinated fiscal, monetary, and exchange rate measures to stem the build-up of price pressures. The committee observed that rates in the foreign exchange market have remained relatively stable in the near term, supported by continued intervention in the market by the bank, sustained high increases in the price of crude oil in the international market, as well as positive developments in external sector. The continued bearish trend in the capital market, due largely to profit-taking activities by investors and monetary policy normalization in some advanced economies, requires a careful mix of policies to stem capital flow reversals. The consideration of the committee. The MPC noted with satisfaction the fourth consecutive quarters of growth in real GDP and the positive growth outlook in the domestic economy. This is shown by the sustained improvement in the manufacturing and non-manufacturing purchasing managers indices in the second quarter of the year. The MPC commended the approval of the 2018 federal government budget and called for an accelerated implementation to further support the fragile growth recovery. Committee also called for sustained implementation of the Economic Recovery and Growth Plan (ERGP) to further stimulate output growth. MPC was, however, concerned about the liquidity impact of the 2018 expansionary fiscal budget and increasing FAC distributions due to rising prices of crude oil, as well as the build-up in election-related activities. Notwithstanding the positive direction of the outlook, the MPC reviewed the effects of the sustained monetary policy normalization in some advanced economies, with implications for capital flow reversals, exchange rate, and domestic price pressures, as well as other challenges to growth during the second half of 2018. The committee took note of the sustained moderation in inflation pressure, especially the headline inflation, as well as stability in the foreign exchange market, but expressed concern on the threat posed by the incessant headers and farmers' crisis in some key food-producing states, the negative impact on food supply chains, which would continue to exert upward pressure on food prices. The committee therefore called on the bank to continue to build on the progress already made in arresting the trend to sustain the moderation in inflation. The MPC also observed with satisfaction the high level of activities in investors and exporters window of the foreign exchange market, which continue to supply liquidity in the foreign exchange market, narrow exchange rate premium, and reduce speculative activities in the market. The MPC noted the continued improvement in the performance of deposit money banks and expressed optimism that the moderation in the levels of non-performing loans in the industry would continue. The committee therefore called on the federal government to accelerate the settlement of outstanding contractor debts and also encourage the bank to ensure strict compliance with regulatory provisions. In discussing the economic report presented to the members, it was observed that as the prices of crude oil prices in 2017 and 2018, the monthly allocation to various levels of government also increased, suggesting that federal government was not conscious of saving for the rainy day. The committee therefore advised the fiscal authorities to build buffers, especially now that the price of crude oil is relatively high. Committee's consideration. Informed by the developments in the global and domestic economic financial environment, the committee painstakingly reviewed the policy options available. In particular, committee considered the sustained positive growth in the real gross domestic product over the last quarter, stability in the foreign exchange market, high level of accretion to external reserves, as well as the deflationary trend. The MPC deliberated on the rise in food inflation, impact of the expected liquidity from the expansionary 2018 federal government budget, and rising FAC disbursements in the second half of the year, along with the build-up of pre-election spending. The committee strongly considered the option of tightening, believing that tightening would curtail the threat of a rise in inflation, even as the injection from the fiscal authority will still provide the economy with substantial liquidity. Notwithstanding the deceleration in inflation, in headline inflation, the current double-digit inflation rate remains above the bank's 6 to 9% target range. In addition, the committee is of the view that tightening will help stem the tide of capital flow reversals in the face of sustained monetary policy normalization in some advanced economies. This, the committee believed, would rein in inflationary pressure and moderate inflation rate to single-digit levels, increase real interest rate, build investor confidence with attendant positive impact on capital inflows, and further stabilize the country's exchange rate. On the contrary, the committee is of the view that raising interest rates at this time would weaken consumption and raise the cost of borrowing to investors in the domestic economy. In addition, the policy will trigger repricing of financial assets by deposit money banks and further constricting to the real sector that would promote a non-inclusive growth without considering the option of loosening. The committee assessed the potential effect of stimulating aggregate demand through lower cost of capital. This could stimulate consumption and aggregate demand. Committee, however, considered its potential relevance, taking into account the expected liquidity injection from the 2018 budget, increased FAC disbursements, and election-related spending ahead of 2019 general elections. If this crystallizes, it will exacerbate inflationary and exchange rate pressures, as well as return real interest rate into negative trajectory. Moreover, lowering policy rates may not translate to an automatic reduction in market rates due to poor transmission mechanism owing to structural rigidities. The committee is also of the view that loosening could reverse the gains already made with reduced importation, which has strengthened the current account balance. It will also lower banks' risk appetite and possible rise in NPLs, which could negatively impact on the banking industry stability. In the discussion for a hold, it was noted that risks to the macroeconomic and financial environment appears fairly balanced, with improvements in output growth and inflation. Holding policy at the current stance would support growth and further moderate inflation. However, committee noted the appetite of the public for loosening and concerned that holding MPR at 14% since July 2016, and considering the dynamic nature of the market, the rate might have lost its signaling effect on the market, hence dampened market expectations. The argument in favor of maintaining the current policy stance is to monitor the magnitude of the liquidity impact of the fiscal injections and election-related expenditure ahead of the 2019 general election. Overall, Monetary Policy Committee was of the opinion that while it is difficult to encourage job creation in an environment with deficit in infrastructure, the committee believes that the bank should continue to encourage deposit money banks to increase the flow of credit to the real economy to consolidate economic recovery. In this regard, the committee believed that a heterodox approach to reform the market to strengthen the flow of credit would be appropriate at this time. Consequently, credit-constrained businesses, particularly the large corporates, are encouraged to issue commercial papers to meet their credit needs at low interest rates and possibly single-digit rates, And the CBN may, if need be, buy those instruments to complement the efforts of the deposit money banks. In addition, as a way of incentivizing deposit money banks to increase lending to the manufacturing sector and the agri sector, a differentiated dynamic cash reserve requirement regime will be implemented to direct cheap long-term bank credit at 9% with a minimum tenure of 7 years and 2 years moratorium to the employment elastic sectors of the Nigerian economy. Details of this framework are being worked out by the Banking Supervision and the Monetary Policy Department and Research and will be released very soon. In consideration of the foregoing, therefore, the committee decided by a vote of 7 members to retain the monetary policy rate at 14% alongside all other policy parameters. 2 members, however, voted to increase the MPR by 50 basis points, while 1 member voted to increase the MPR by 25 basis points. Consequently, the MPC voted to retain 1. the MPR at 14%, 2. CRR at 22.5%, 3. liquidity ratio at 30%, 4. asymmetric corridor at plus 200 and minus 500 basis points around the MPR. I thank you for listening.
I've listened to you, and I would like you to shed more light on the CRR innovation that you are trying to introduce to make banks lend to people. This is not the first time. At some period, we even reduced the CRR for banks, and we didn't see them lend so much to customers, particularly the private sector, to fix infrastructure. Can you tell us what the novel strategies that you are really employing to ensure that this time around they bring out this money from their vaults?
Thank you, Mr. Governor. My name is Sanya Adejo from the Nigerian Tribune. It's about the foreign exchange market. Now, there was something you did which people are enjoying. You directed banks to sell foreign exchange to customers on the counter once they are able to show proof that they are traveling. And some people are now able to get it at 305 naira.
360.
360.
Okay. So he's got his clarification.
Governor, good afternoon. Udo is my name. You said in your speech that the currency swap has taken off, and I know that a lot of Nigerians are still apprehensive about the benefits to Nigeria because they say that the arrangement tends to favor China more than Nigeria. Can you give us an update as to the 1 week that this currency arrangement has taken off? Then number 2, you also alluded to
other people.
Let him ask. Let him ask if he's not if he's related. That's okay.
Thank you for pointing my
Provided you don't hit me.
So the other issue has to do with the declining foreign reserve.
Yes.
And you also alluded to the fact that it has grown from 47.79 in June to about 47.2. Correct me if I'm wrong. We don't know exactly where are these things, the reserve going into. Is it politics or something? Can you go?
Thank you.
Good afternoon, Governor. My name is Chidamara from Civil TV. Aside the gains in the currency swap with the People's Bank of China, can you also let us into the interbank exchange rate since you commenced the sale authority in your
No, say that again. Oh yeah, right. Okay, more clarification on the auction.
I think this is the last question.
Yes, I'm from KSFM. No, the last speech, the last statement you mentioned on the differentiated cash dynamic regime that will be created with single interest rate. Is it going to be through this banks as well, or there's a financial regulatory body that's going to handle it because of all the other issues that will begin to arise when it comes to banks
to lend money to the real sectors and the agri sectors of the economy, and I think I see also issue of the FX market and all that. The MPC deliberated extensively on the issue of what can be done to encourage banks to increase credit. And because at the numbers that we looked at during the May meeting, MPC was concerned that credit to the economy was sliding and that there was a need for us to incentivize the deposit money banks to be able to increase credit to the sector. At this meeting, we found a somewhat improvement, which is gratifying, but we feel that we must still do what we want to do. Two approaches were considered. The first approach is where we said that in order to achieve the objective of lowering interest rates, particularly to those priority sectors, manufacturing sectors, and the agri sector, that we would encourage large corporates to issue commercial paper notes in the market. Naturally, when they issue commercial paper notes, there will be information memorandum that will spell out the details of what they're going to do with that money. And that in order to complement the efforts of the banks, we would expect that those commercial papers would come at low rates, as low as single digits, let's even say 9 or below 10, and for long tenors, in this case as high as 5 years or 7 years, with moratorium, with specific purpose for that loan, and that if central banks sees those kind of notes in the market, will complement the efforts of the banks through any mechanism to support that by lending to that corporate at that single digit rate. It is not meant to be in competition with the banks. It is meant to complement their effort because the monies will still flow through them anyway. But the important thing that we want to see to it that our objective and to see to it that we achieve lower interest rates, possibly single digit, can go through these means. Two, is the approach where we said, if a bank loans money, this time for new projects and plant expansion, verifiable, not refinancing, to a project for 7 years, inclusive of 2 years moratorium, at 9% interest rate, that bank, providing those evidence and verified by the central bank, that we will go into that bank CRR and release cash from our CRR and release that equivalent sum to that bank at zero cost, in which case that bank earns a spread of 9% on that money. We feel this is novel. It is something that we should give a chance. In the past, you are very correct, we had reduced CRR and released liquidity into the market, but the liquidity was not channeled to the high impact, we mean employment generating sectors and productivity or output improving sectors of the economy. And that's why we decided we should approach it through these means. We believe this would work because we know that from time to time, monitoring the level of liquidity in the market, that rather than the banks use their monies to buy T-bills, that they can put this in these sectors and that we would provide the liquidity to fund these transactions as long as they meet these specified terms and conditions. That's what, but some more details of this will be unfolded and provided to the banks and the public for them to know. Second, on the FX market, banks to sell FX at, we've addressed that it's at 360 naira to the dollar. Premium Times talked about the currency swap, apprehension about its success. I repeat, China remains Nigeria's largest trading partner. And because payment imports have to be paid for, we're saying this time those imports can be paid for using renminbi rather than in dollars. And that we would encourage people who are importing in renminbi, using renminbi, by offering some discounts that would encourage them to go for renminbi bills, because we have this swap deal with the People's Bank of China, and that we think this should encourage more people to embrace the use of renminbi for trade between Nigeria and China. We opened the first auction last week Friday, and the results from that auction will be released on Friday. But the preliminary information I have is that it was a very successful auction, and by the time the auction results are released, those who bidded at the kind of rate that we think is good enough to encourage more of those renminbi trades, and I'm sure the details will be unfolded by Friday. I think that is it. Yep. Thank you.
Reserve, sir.
What?
Reserve.
Okay, on reserves. Yeah, you talked about reserves. That declining reserves, that is it going into politics? My answer is categorically no. There's nothing like that. What is happening is that as a result of the US Fed normalization, we've seen that interest rates have gone up in the US and in some advanced economies in an attempt to encourage and stimulate the economy. Those funds that moved into the emerging and frontier markets during the period of quantitative easing are now reversing back. And by their reversal, it means that we see more of outflow of capital than inflow of capital. And of course, we've had our own share of it. You must note that Nigeria has performed very, very well amongst emerging market economies on this subject. And I mean, it's no secret, whether it's South Africa, whether it's Guinea, whether it's Turkey, whether it's Indonesia, have all suffered what I can call substantial depreciation in their currencies. But our exchanges have remained stable because we were able to build enough buffer to support our currency. And that is why the exchange rate has remained stable at about 360 naira to the dollar at this time. Thank you.
Yeah, thank you, Governor. It remains for me to say to you, thanks so very much for coming in July. We'll see you again in September. Bye-bye.
So when they come early, they don't come back. What do we do? Have to wait.
I'll try.
And